All right, we've been getting a whole lot of macro, and that's my favorite thing to talk about. That's probably the most important thing that determines the soil of the market. And if you saw what happened on January 1st of last year and what happened on January 1st of this year, it becomes quite clear why this macro is very important. At least in terms of trading, it seems that that's almost too perfect for tech, the, Apple type stocks, to peak on January 1st last year and to bottom on January 1st this year. But nonetheless, let's take a look at the macro and evaluate it. First thing I want to talk about, because it seems to be the hottest topic, the debt ceiling. The debt ceiling does seem to be the hottest topic right now. And it's gluing us all to our phones. It's gluing us all to the futures. We're trying to see how the market is going to react to some statement. And it definitely seemed to have to play in part on Thursday and Friday's rally last week. Quite tremendous rally off of what is virtually nothing. This is really a nothing burger. This debt ceiling issue, at least on the upside. We've never had a default. It's not like any new economic activity is going to occur because the United States can now borrow some more money. If anything, in my opinion, it's only a downside catalyst regardless of whether or not they actually come to an agreement. If they don't come to an agreement, for all the obvious reasons, that is bad. That changes the risk-free rate of return notion because now it becomes no longer risk-free. The United States begins to default on debt, et cetera, et cetera, et cetera. Not so good. But even if they do raise the debt ceiling, why would that be a bad thing? Well, that would be a bad thing because we talk about the importance of liquidity, cash on the sidelines, cash running into the market, and interest rates, of course. If the United States has to go into the market and sell all this debt, they're going to take a bunch of this cash off the sidelines. They're going to flood the market with treasuries. That's going to increase supply, cause interest rates to go up. And that is an interesting thing. So as far as I'm aware, the only possible situation here is for the market to pull back on the debt ceiling, whether or not it actually goes through. I could see it pulling back on either situation, whether or not it goes through. And I don't see any reason for the market to rally on the debt ceiling. I think that's simply fear of missing out, short covering type behavior. I don't think that's fundamental analysis. And that's what I think we saw on Wednesday and Thursday of last week. So that leads us to the next macro event, which is the idea of interest rates. Interest rates have been going up like every day for the last week. The 10-year is at multi-month highs. There's a lot of debate about whether or not we're going to get another interest rate hike or whether the Fed has actually paused and pivoted. And before we get into that, let's just take a look at the fact that the bond market is ripping, or yields are ripping. The bond market is selling off aggressively. So if we're trying to figure out and decipher what the Fed is saying, look no farther than what the bond market is telling you. The bond market is telling you they're nervous. They see what the Fed is saying. Kashkari's talking about 6%. Okay? They're not looking for Black Monday. That's not their goal. The Federal Reserve does not want to go down in history as having caused Black Monday. But they do want to go down in history as the Federal Reserve that didn't let 1970s style inflation take hold and successfully navigated us through a pandemic without a total financial crisis. So they are going to try and actually get this inflation situation under control and not let it get worse. People want to figure out, are they talking about pause? A lot of people seem to think Powell on Friday was talking about a pause. Well, now you hear the Fed members following up. They're not really talking about a pause. I get it. Kashkari said, he could see the case for a pause. But he completely changed the definition from a pause to a halt, basically. I don't remember the exact word he used. But a pause to him no longer means a pause and hold, which is what Messer was trying to say. She was trying to say, it's not a pause, it's a pause and hold. We're going to stay higher for longer. We're not going to start cutting like the market expects or change our quantitative tightening path or any of that. That's not what they're doing. they're raising and holding at this higher level. Well, Kashkari's talking about 6%. And 6%, we're at 5 to 5.25. So clearly, he is comfortable with at least one more hike if he is beginning to float the idea of 3 more hikes, at least 3 more hikes, okay? Bullard is saying very confident in 2, and more importantly, he's moving or suggesting that there's consensus because there has been very large consensus on the Federal Reserve. Yes, some of the dot plots are different, but they are very, very in tune with each other. They talk with each other all the time. Powell talks about this when he provides deep nuance. Nobody is going to, go out on a limb and throw the rest of the Federal Reserve members under the bus. That's what they don't want to do, particularly the ones who want to fight inflation. What they want to do is show that they're together, and because they know, they knew this market pressure was going to be on them to cut, to pause. They knew that they think it can get so bad. It can get so bad. When Volcker did it, he was getting literal death threats because unemployment was rising. It was bad. They know this is going to happen. So they are very much focused on being together and being solid, and they're all committed to getting inflation down to 2%. And there's only one way to do that, and that's increase interest rates and slow down the economy. But the economy is not slowing down. Atlanta Fed is increasing their GDP forecast well above 2%. Bullard said the previous SCP, the dot plot, expected rates to be at 5.1. That's where we are now, 5.25, based on the assumptions that inflation was going to fall in a rather quick fashion and economic growth was going to slow to 0. And he didn't say this, but I'll also include that unemployment was going to rise above 4%. Those were all the assumptions that they had to assume the current rate we're at now is the rate where the median would be to pause and hold. He said none of those things have materialized. So what does that mean? That means the dot plot is going to go farther. It's going to go higher. So whether or not the Fed decides to pause at the next meeting, I mean, it's somewhat relevant. It's somewhat relevant to wait 1 month and see if there is an economic crash. I think basically what they're trying to do is prepare the market for the possibility of more than one additional hike. That is what it's starting to seem like. I'm not willing to say publicly that I think that's the most likely outcome because I don't want to sound too crazy, but they aren't trying to sound too crazy. Kashkari isn't throwing out that 6% number for fun. Okay? This was an obviously discussed situation amongst Federal Reserve members. It's obvious that he was the first one. He put out an article in the Wall Street Journal yesterday with Nick Timiraos, was the first one to speak this morning, both completely unscheduled, at least on economic calendar type things. And then he was immediately followed up by Bullard. Like this is coordinated. These people work together. They are on the same committee. They have the same job. They have the same goals. This is not random, okay? This is very well choreographed, telegraphed. They know what the market's doing. They need to move the market without completely shocking it and, having the market choose to fight back against them. So, you see what I'm saying here? You see what I'm doing? Anyways, so it seems to me, and it seems to the bond market, that the market's expectations of the Fed are quite off. That they're at the very least not going to be cutting this year. That seems very easy to eliminate. And more likely than not, there's at least one more hike this year. At least. Okay? At least. I get it. You can argue that inflation headline is coming down or that, something like that. It doesn't matter what you think. It matters what the Fed thinks. And they're saying the data is not indicating they should stop. They're floating 6%. If they were trying to, if they were leaning in the pause direction, why the heck would they float 6%? Why would they do that? There is no reason to do that, okay? There is no reason to do that. Clearly, their interpretation of the data, of the situation, of the fact that we've been hiking at this record pace for so long and core inflation is simply not moving, clearly that's bothering them. And they're going to err on the side of over-tightening. Powell has used that term, over-tightening. He has said they want to over-tighten because if they do over-tighten, they have the tools to correct that, to fix the economy and to stimulate. They can do that if they did over-tighten, if the economy did suffer more than they wanted, if growth did slow too much, if there was a hardcore recession, they can solve for those problems. So, I think this is a side of the market that the market is not prepared for, obviously, because it is ripping hard, aggressively, expecting rate cuts, yada, yada, yada. But we can see, if we take a look at what the Fed is saying, the people who actually make the decisions in isolation and ignore our own judgments about the situation, ignore the market's expectations for the situation, if we listen to what the Fed is saying, talking about multiple rate hikes this year, talking about more than that, possibly 6%, listening to Jamie Dimon, listening to Bullard on the dot plot, Mary Daly also on the dot plot saying, it's only good for a day. Well, Bullard said the things that caused them to do what they were going to do, they're not playing out. Also, the bank stresses have subsided quite significantly. So, seems to me higher for longer. How much higher is unknown, but for longer than cutting rates this year, that's for sure. Even people who have said they are leaning towards a pause, although not fully committed to that, like Bostic, have said well into 2024. There's a definite disconnect between the Fed and the market, and unless the market is right that some hardcore recession is coming or inflation is going to drop like a rock, and that means core 2, which is currently in the 5s, it's getting crazy. So that's today's video. We'll see what happens in this market. Until next time, peace out.